Have you ever wondered what the Federal Reserve is really thinking? You know, when they make those big economic decisions that seem to ripple through everything. Today, we're taking a deep dive into an official statement. It's from one of the most powerful economic bodies in the world, the Federal Open Market Committee, the FOMC. Our mission today isn't just to, read you the statement.
Right.
It's to cut through all that dense financial jargon, pull out the key insights, and really get what the FOMC is saying about the economy and, their latest policy moves. We're focusing strictly on the nuggets of knowledge from their recent official statement. Think of it as your shortcut to getting up to speed on some critical economic news.
Exactly. And what's really fascinating here is that this statement, well, it's much more than just a dry list of decisions. It's really a carefully crafted window into how the committee, as a group, sees our complex and, frankly, ever-evolving economic landscape. So we're going to explore their foundational goals, get a snapshot of how they see the economy right now, and then unpack the specific actions they've actually decided to take.
Okay, so before we even get into what they decided, let's nail down the why. What's the guiding star for the FOMC? What's their long-term objective that underpins every single decision they make?
Yeah, that's the perfect place to start. The committee operates under what's known as its dual mandate.
Right, the dual mandate.
Basically, they're always aiming for two long-term goals: maximum employment and inflation at the rate of 2% over the longer run. These aren't just buzzwords, they're the foundational objectives. Everything else really stems from that.
So they're constantly balancing those two aims.
Exactly, it's a balancing act.
Okay, so with those two big goals, full employment and stable prices, always in their sights, what picture did the latest data paint for them? What's their current read on the economic pulse right now?
Well, the committee observed that, and I'm quoting here, growth of economic activity moderated in the first half of the year.
Moderated. So cooling down a bit.
Yeah, essentially. The economy's pace has cooled down some. And this moderation is significant because it suggests their earlier efforts, tightening monetary policy, are indeed having an effect.
Okay.
They also point out that swings in net exports continue to affect the data.
Ah, right. Imports and exports messing with the numbers a bit.
Pretty much. It just means the balance of what we sell versus buy internationally can create some volatility in the overall economic figures.
Got it.
Now, on the employment side, they note the unemployment rate remains low and labor market conditions remain solid.
So that side of the mandate looks good.
Right, that's the positive side. However, the other side is still challenged. Inflation remains somewhat elevated.
Still sticky, huh?
Yeah, and they acknowledge that uncertainty about the economic outlook remains elevated.
Meaning it's still hard to predict what's next.
Exactly. There are still a lot of unpredictable factors at play. And they specifically say they're attentive to the risks to both sides of its dual mandate, meaning they're watching out for inflation getting worse and the economy slowing down too much.
Okay, here's where it gets really interesting, the action part. Given that mixed picture, moderated growth, solid jobs, but inflation still high, plus that cloud of uncertainty, what was the big decision? What did they do with interest rates? Did they hike? Cut?
They decided to maintain the target range for the federal funds rate at 4.14 to 4.12%.
Ah, so they held steady, no change.
No change this time. Now, for those less familiar, the federal funds rate, that's the benchmark for overnight lending between banks.
Right, and it influences everything else.
It really does. It affects a huge range of borrowing costs across the economy, your mortgage, car loans, business investment rates, you name it. So maintaining it signals they think the current level is, well, appropriate for now.
Okay, so holding the rate steady was the main decision. But the Fed has other tools, right? It's not just about that one rate. Were there other levers they're pulling or, continuing to pull?
Absolutely. Yeah, the federal funds rate is just one piece. The committee also stated they will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities.
Okay, that's the QT, right?
Yeah.
Quantitative tightening.
Exactly. That's the ongoing process, QT. To put it simply, during the pandemic, the Fed bought trillions in these bonds. Think of them as IOUs from the government or government-backed entities to pump cash into the system.
Right.
Now they're letting those bonds mature without reinvesting the money. So effectively, they're draining some of that extra liquidity, that extra cash out of the financial system.
So kind of like slowly taking some money off the table.
That's a good way to put it, yeah.
Good.
It generally makes money a little more expensive to borrow and helps cool inflation down.
Okay, that makes sense. What about looking ahead? Did they give any hints about the future?
They did. Their forward guidance is always crucial. They emphasized that when considering future adjustments, they will, quote, carefully assess incoming data, the evolving outlook, and the balance of risks.
So not on autopilot, data dependent.
Very much data dependent. Every
Okay.
decision depends on the new information they get. They also reinforced their strong commitment, again, to supporting maximum employment and returning inflation to its 2% objective,
Sticking to the mandate.
sticking to the mandate. And importantly, they highlighted their flexibility. They said they would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals.
Meaning they can pivot if things change unexpectedly.
Precisely.
Yeah.
And to make those calls, they're looking at a really broad range of info: labor market conditions, inflation pressures and inflation expectations, and financial and international developments. It's
Yeah.
a constant, data-driven balancing act.
Now, when these big decisions are made by a committee, it's not always unanimous, is it? You often get different perspectives. So who was on board with holding rates steady, and were there any dissenting voices this time? Anyone who wanted something different?
That's a really important question because you're right, the FOMC is made up of individuals with their own views, and getting complete agreement on these complex issues is pretty rare. Voting for this decision to maintain rates were, well, the names you might expect: Jerome Powell, the chair; John Williams, the vice chair; plus Michael Barr, Susan Collins, Lisa Cook, Austin Goolsbee, Philip Jefferson, Alberto Muslim, and Jeffrey Schmidt.
Okay, so that sounds like a pretty solid majority then.
It is, yeah.
But you mentioned different perspectives. Were there actually any against votes this time?
Yes, there were. And this is crucial. Michelle Bowman and Christopher Waller voted against this action.
Okay, against holding steady, what did they want?
Their specific reason: they preferred to lower the target range for the federal funds rate by 14 percentage points at this meeting.
Ah, so they wanted a rate cut. A small one, but still a cut.
Exactly, a 25 basis point cut. And this dissent, it isn't just a minor disagreement. It really highlights a genuine debate happening inside the Fed.
So Bowman and Waller are maybe more worried about growth slowing down.
That's likely the signal, yes. They might believe the greater risk right now is the economy slowing too much, and they're prioritizing avoiding a deeper slowdown by pushing for a slight rate cut now.
Interesting.
Yeah. And it's also worth noting, Adriana Kugler was absent, so she didn't vote.
Okay, so what does this all mean for us then? We've got a clear majority saying, let's hold rates where they are, which suggests they're still pretty focused on inflation as the main problem.
Right.
But then you have this specific dissenting view, two members saying, no, maybe we should cut a little, signaling some concern about economic deceleration. That's a fascinating snapshot of the internal debate, isn't it?
It really is. It shows the different risks they're weighing.
So let's quickly recap. We've taken a deep dive into this FOMC statement. It paints a picture of a committee, carefully balancing solid employment with inflation that's still stubbornly elevated. They've decided to maintain current interest rates,
Yeah.
keep doing that quantitative tightening QT,
Yep, letting those bonds roll off.
all while keeping a very close eye on the incoming data and staying really committed to their dual mandate: maximum employment and 2% inflation. And this matters directly to you listening right now because these decisions influence everything: the cost of your loans, the health of the job market, even the purchasing power of your money.
Absolutely. It touches almost every part of the economy.
So this statement, it really highlights that constant kind of nuanced dance the FOMC performs between all these different, often conflicting economic signals and their long-term goals. Given those dissenting votes we just talked about and their own stated elevated uncertainty, how do you think their next assessment of the balance of risks might play out? What factors, what specific things do you believe will weigh most heavily on their future decisions as they navigate this pretty complex landscape? Something to chew on